Very good morning to everyone and welcome in our fifth session on transfer pricing methods, and today we will going to discuss profit split method. On your screens I am Gaurav from New Delhi, representing Garg Economic Advisors Private Limited. So let's start discussion on profit split method. We have already discussed four transfer pricing methods: comparable uncontrolled price method, resale price method, cost plus method, and transactional net margin method. Today we are discussing profit split method. So I generally put profit split method in third basket. So if we wish to understand transfer pricing methods, one can create three baskets. Put cup in one basket. In second basket, one can put resale price method, cost plus method, and transactional net margin method. And in the third basket, one can put profit split method. So cup, which basically deals with the prices. In second basket, we have RPM, CPM, and TNMM, which ensures margin at the gross level and at the net level. In the third basket, we have profit split, so which talks about splitting the profit. So unlike wherein you are ensuring the profits, in this case you are splitting the profit. And when you split the profit, very interesting case, when you split the profit, you split the profit when someone has got share in the profit. So with whom you split the profit? With everyone, or only with your partners? So you only split the profit with your partners and not with everyone. So when it comes to transfer pricing, we will use profit split method when there is a requirement to split the profit. Means when you and your group company, they are acting in a transaction as partners. So what is the role and responsibility of partners in general? Partners share in capital, partners share in risk, partners share in functions. So if partner is sharing in a risk, you can give return to that partner based on the investment return, something like let's say the interest to that partner or dividends to that partner. If that partner is contributing in form of functions, you can remunerate that partner based on let's say the value of services provided by the partner or the value of goods provided by that partner. But what if that partner is sharing risks with you? How you will remunerate? I feel the profit split method addresses that situation when someone becomes partner to you in your risk. And in the transactions with the group companies, it means when the two companies are acting or involved in a rendering of service to third parties, or involved in a production of goods or marketing of products in such a way that both the entities are assuming significant risk, or say economically significant risk. So if both the entities are involved in assuming significant risk, we need to apply profit split method to divide the profit, to split the profit. Otherwise, you can apply any other method. So for example, let's say there are two entities in the group, and I believe most of the accountants are watching this video. So in order to explain them with the relevant example, let's say there are two firms. One firm is good in audit, another firm is good in tax, and the partners of both the firm approaches to the client. Client denies work to both of them and says, I'm looking for a service provider who can render both the services. Means a service provider who can provide audit a service provider who can provide tax services. So let's say the partner of both these firms, in the evening they met over a coffee shop. They discussed the issue that we need to come together and then pitch to the client. So they decided next morning to go to the client's office jointly and tell to the client that now we are a one firm. So accordingly they went to see the client and client gave them the work. So friends, the work, we need to understand now why the work is coming. The work came because of the audit partner or because of the tax partner or because of the synergies that got created when those two guys joined the hand, when the two firms came together. And most of you would agree that the reason for winning the client in this example is the synergies that is generated when two firms came together. And now let's say the client gives $1,000 to the firms for carrying out the assignment. Now if client is giving $1,000 to carry out the assignment, how you will split? Can the audit partner say to the tax partner, you generally render a service for $300, you take $300 and go away? Or can a tax partner say, you generally render service for $500, you take $500 and move away, the balance belongs to me? No, it can't happen. Because now the result is because of the integrated activities, integrated service, sharing of risk. Now if this is the case, that the integration, that the revenue is getting generated because of the integration, because of the sharing of risk, the profit needs to be split. Now how one can split the profit? One can split the profit by two approaches. One approach is you apply total profit split method. Another approach is you apply residual profit split method. Now what is total profit split method and residual profit split method? Total profit split method is also known as contribution analysis, and residual profit method is also known as residual profit analysis. So in contribution method, now contribution method would generally be applicable wherein you cannot apply residual profit split method. So let's first understand where we can apply residual profit split, and in the balance scenario we will apply the total profit split. So in residual profit split, there are chances that you can segregate transactions. You can segregate the activities performed by both the partners in the transactions. Now, once you have segregated the activity, first you will give the normal return on those activities to both the partners or both the group companies. And then balance or the residual profit will get divided based on the economic significant contribution made by those entities or those participating firms. This is called residual profit split. In case of total profit split, or where we can apply the total profit split, this division of transaction, the segregation of transaction is not possible. Generally the activities are so much integrated that it becomes really tough to say that to this activity I can give the normal return. Generally it is not. So in a case wherein it is not possible to segregate the transactions and to give them the normal return and then to give them the residual profit, we prefer total profit split, or you can apply total profit split. In total profit split, we are going to value the contributions made by each participating firm or group companies. So the value of contribution could be based on the market value, or if they are providing the costing data is available, then from there you can pick up the value of the services or value of the contribution. Then based on the value of the contribution made by each entity, you will divide the we will compute the cost of the services, cost of the activities, total revenue we need to take that got generated from the transaction, and then when you divide total revenue, when you subtract total revenue less the value of contribution, you get the profit. So the value of contribution will go to the each participating entity, and the balance, that is the profit, will get divided based on the value of contribution made by each participating entity. So in this way we can apply profit split method. A lot of action is happening in the profit split method. Under the BEPS project, the OECD is visiting or is in the process of revising the guidelines with regard to profit split method, and the draft guideline is already there in a domain, and one can provide a comment in the September, by 5th September, to the OECD on the profit split method. It envisaged 3-4 situations wherein one can apply the profit split method. I've already tried to explain those situations by way of very simplistic example. We can take a couple of more examples. The situations that are there in the draft guidelines are, the operations are highly integrated. Both the entities carry unique and valuable contribution. And then there is group synergies. Let's take another example to understand where you can apply the profit split. Let's say one entity has got certain intangible with them, and another entity again has got certain unique intangible. Now both the entities, when they are going to market, they are joining their intangibles and creating third intangible. Now whatever the return will get generated, that belongs to both the two entities. Another example could be, let's say one entity owns marketing intangible, another entity owns product intangible. So now the entity which owns product intangible, that entity can be remunerated based on the royalty, or if that entity says, or there is kind of a discussion, that the success of the product in the market is dependent on both the product intangible and the marketing intangible. Means the marketing guys are still not sure whether the product will get accepted in the market or not. So instead of paying royalty, both the guys can become a partner. When both the guys are becoming a partner, the profit that will get arise needs to be shared among both the partners. Among the firm which owns the product intangible and among the firm which owns the marketing intangible. Generally, the challenge in applying profit split method is to find comparable transactions or a comparable scenario based on which you can derive the ratio to split the profit. So there, the valuation of contribution becomes very important. With this, let me end my session for the day, and if you have any query, feel free to ask. Okay, we have not received any query. Now all these 5 videos on the transfer pricing method, which basically covers the basic about transfer pricing method, are available on our Facebook page, that is Transfer Pricing Updates. You can visit, you can listen to all the videos, including the video on profit split method. And in future also we will going to put the short videos on transfer pricing. So keep visiting our page.